All right. We are live for our
We're live.
May market commentary. Welcome, everybody. We're excited to actually give you some of the information here. Some of the information is going to seem slightly what you've heard before, but we have new data to share on some of these different areas, such as inflation, the markets, and the PE ratios that we've been discussing. But folks are joining in. So while we do that, we'll just do a little brief kind of housekeeping. I'm joined by my counterpart here, Austin Costello, a fellow CFP. This needs to be updated. I've been doing this for 20 years. 15, that is garbage. Okay.
We're not giving you enough credit.
I started in '05 for the record, guys. But you could say that I've been working with federal employees for around this time frame. But there is a chat feature, right, Austin, that,
Yes.
that folks can put some of their questions in, and we can take those at the end. So if you guys have questions, feel free to drop in some of those questions there on the chat feature. Um, Other than that, right? I think we can get into it, Austin. What do you say?
Yeah, that sounds good. And what I will say is, I know a couple people have had issues in the past with the chat. We tried to fix that this time. If you do have an issue and you have a question, though, just email us, seminars@retfed.com. We'll get you our email address and we can respond to questions that way. But yeah, let's get into it.
Awesome. What do you
All
got
right.
for us on the inflation front?
So we are, as we've been going through these market commentaries each month, if you've been keeping track, a lot of it is, like Neil said, we're covering the same data. We keep covering inflation. We keep covering interest rates. We keep covering some concentration in the stock market. But these are the big things right now that are defining where valuations go, what the economy is doing, what we can expect going forward. And so, part of what we like to do on these calls is just give you guys an update of where things are, where they've gone since the last time we talked. And a big one that we haven't focused on in a little while is inflation. And the reason we haven't focused on it in a little while is because, well, it was moving in the right direction, right? It was coming down and it was kind of boring to talk about where, hey, we got this great downward trend in inflation, but as you can see throughout the latter half of 2023, moving into 2024, we kind of started to move sideways and have actually recently, this core inflation number has been ticking upward. And in large part, that's the reason the core inflation, or actually the headline inflation, that not the core inflation, has been ticking upward, is because we've been seeing gas get a little more expensive. That's included there. In core inflation, food and energy are excluded. That's been a little more stable, but still not getting anywhere near the Fed's target of 2%, where they'd really like it to go. Now, looking at things this way is a little bit interesting. Okay, I want to back up here for a second and show this chart over to the right. A lot of times we're looking at the annual change in inflation. What's the change from April of 23 to April of 24? But what's important to look at when thinking about where this number is headed in the future is our month to month number as well. That kind of shows us where we're headed for the year. And if you look here, this month to month number for March and for the last couple months has been 0.4% per month. Now, if we look at what that could mean in an annualized inflation reading, if we continue at this 0.4% month over month, we're actually at a point where we're going to start, accelerating here, picking up and being close to 5% by the end of the year.
And even if we were at 0.3, it looks like an acceleration.
Even if we were at 0.3, right? We're still hovering around this 4%, actually picking up a little bit year over year if we're looking down to December. So in order to really start conquering inflation, getting it closer to that 2% target, we're going to need to start seeing 0.2%, 0.1% month over month numbers. And that's why, if anybody was paying attention yesterday when the Federal Reserve had their meeting, they said, we're not moving rates. We're not going to decrease them. We don't think we're seeing enough in terms of inflation coming down. And that's why we're starting to have this feeling of, hey, interest rates could be higher for longer. And the market's starting to expect that too. There's been a dramatic change from the beginning of the year to now on what the market has been expecting in terms of rate cuts this year. We started out this year in January, and the market, the stock and the bond market, were pricing in 6 interest rate cuts this year. So about 1.5% worth of cuts between January and December is what the market was pricing in, what everybody was expecting, and why we saw, the bond market kind of start to rally at the beginning of the year. We saw stocks do well. Stocks have continued to do well, but what especially the bond market is pricing in now is somewhere between 1 and 2 cuts maybe this year, and rapidly trending towards none.
Right.
Now, the Fed hasn't given any updated guidance yet on the number of cuts they're anticipating. They're still saying it's a possibility. Analysts are still pricing in or assuming, based on what the Fed has said, that they're planning for about 3. But again, we can see the market is starting to doubt that and plan for rates being higher for longer. Now, of course, this has impacts on mortgage rates remaining higher. We're seeing mortgage rates up, average around 7.5% right now. It's, any consumer debt, auto loans, things like that. Those are going to be higher for longer. It's going to put some pressure on businesses, anyone issuing debt. But when we look back historically at what the market has actually done when interest rates have remained higher for longer. So when we look at these, there's all these times throughout history where we've gone through rate hiking campaigns, right? And each of those times we reach a peak rate, and then eventually we start coming down. And what this chart looks at is the average number of months from the last hike to the first cut. So how long were we plateaued at that top, that highest rate? On average, it's about 8 months. And at this point, this rate hiking cycle has actually been, now we're at longer than average. Okay, we're longer than average, but we showed a chart on this on the last presentation. I don't have it included here, but during those longer rate pauses, the stock market has actually appreciated that. The stock market appreciated that. And when you look back into the 1980s, you can see here, 70s into the 80s, there were pretty short pauses. And then they started decreasing rates. And what we found is they started decreasing rates too early. That caused inflation to reaccelerate. And that's really what they're trying to avoid. So you can see since the 90s, the Fed's been a lot stingier in what they're doing before they start to decrease rates. They've been holding on a lot longer, before they finally agree, okay, we're out of the woods here in terms of inflation. We can start decreasing. So we're expecting, hey, they're probably going to do the same thing.
And to me, I think that's the right move, right? Why decrease the rate when the economy looks like it's doing fairly well? Obviously, there's some things underneath that could be a little bit concerning, but everything right now is humming along nicely. Why change that rate to stimulate more growth and maybe increase inflation?
Exactly right. Yeah, they're walking a very fine line right now between, we want to maintain growth, but we don't want to necessarily stimulate, like Neil said, additional growth when inflation is already high. And Neil has some ideas or things here to talk about on what's actually going on in the economy, what we're seeing, what the impacts of this have been, and yeah, Neil, talk us through that. What's happening in the economy, and how is this all playing out in the stock market?
Yeah, so I think we keep coming back to this, like this unique scenario. I mean, it's played out before. I would say that it's played out more in the late 1990s, where there's a group of stocks, right, that are propelling this market forward. And I think we're kind of been mentioning this in other sessions, but here you have it, right? All of the market's earnings growth year over year has pretty much up until now come from the Magnificent Seven, right? Seven companies have attributed in terms of the earnings growth of the market. And the rest of the 493 companies, right, are not contributing to those earnings. So that's what we've seen up until now. However, the expectation, right, is that the earnings growth is likely to begin to reduce for those top, let's say, 7 companies, top 10 companies, while the other part of the market hopefully starts to catch back up, right? And this would sort of negate the thesis of some sort of difficult recession coming, because if obviously these companies, the other 493, come to the rescue once the 7 companies finally stop supporting this market completely on their own, it would allow more of a kind of carryover. Now, what I will say to that is, barring any sort of real difficult economic environment, right? These estimates for the other 493 companies are barring that. So if there is some sort of economic shock, the earnings growth may not come for the other 493, and also could drop for that Magnificent Seven. And that's how you would have a surprise on the other side of this to the stock market. Austin, do you have anything else to kind of chime in on this slide?
Yeah, I mean, there's one thing that I think is interesting in looking back. We've been doing these commentaries for over probably a year and a half now, and when we started doing them back in 2023, the data was looking like, oh, inflation's high, rates are climbing for sure. There's going to be a recession, right? There were people pricing in 100% probabilities of recessions in 2023, and it didn't happen. But when you look at, if you would have removed these 7 massive tech companies that have been driving the market last year, you see there's been a full year of negative earnings growth in the rest of the market. We probably would have been in a recession. We were really saved, or the market was saved by these big tech companies. And so I just think it's interesting looking back at all the data. It's not that the data was necessarily wrong, or that people were wrong about these companies struggling. It's just nobody foresaw this extreme growth happening in the other side of the market. But what that now, the position that puts us in is, we've got these companies that have been the only ones growing, that are looking a little expensive potentially because everybody's trying to find growth the only place it's coming. But these other companies that have been at this lower value are looking at a better value, and I think, Neil, you have some things here to talk through on that, on the difference being there.
Yeah. So basically what this chart kind of shows, and it's kind of on the smaller side, but this is a chart that takes us back to 1997. And it allows us to see the trade-off between valuations of value versus growth in the S&P 500, right? There are times when value has been inexpensive and growth has been expensive. And there have been times where that has flipped. So when you're essentially above this dotted green line, that is when growth is cheap and value is expensive. So as you can see through from the recession on, the gray bar in the 2008 recession, from the gray bar, growth was relatively cheap. What are some reasons why growth is cheap? Well, number one, after recessions, usually growth gets hit the hardest. So when we talk about growth stocks, we're talking about stocks that trade at high multiples. Think tech companies, consumer discretionary companies. Usually those get beat up really hard. And that's what you saw. You saw a changing of the tide, if you will, right? Changing of the guard, where growth was now cheap. They got battered the worst. Another thing that happens is interest rates get dropped after recessions, right? Growth companies do really well in low interest rates environments, right? Because a lot of growth companies at first aren't profitable. They need lower interest rates, right, to grow their companies. They need loans, things like that. So through the era of '08 to all the way up until almost COVID, growth was cheap. However, that is flipped, right? Growth has become a lot more expensive. You're underneath the green line right now. And now value, think value is Johnson and Johnson, right? What are some other examples, Austin? I'm stumbling a little bit.
Walmart, Procter and
Walmart.
Gamble, Costco, Home Depot.
Throw in some
Those
dirty
types of companies.
stocks in there. Exxon, Chevron,
Yeah.
right? These are value stocks. They tend to pay dividends, but they are now on the cheaper side of the market because growth has led this charge upward. So if we look below at the box that is a little smaller here, we can see that value is currently trading at around 16 times price to earnings. So again, we're paying $16 for every $1 of profit from value companies from the basket that we just kind of mentioned. The long-term average for that is around 14 times. So we're not very far off in terms of expensiveness to value stocks. We're actually right within the norm. Okay. It's the growth side of the market, the technology side, the Magnificent Seven, the rest that would come in the AI basket that is very expensive compared to the long-term average. 28 times earnings. So again, for folks that don't know really what that means, you're paying $28 for $1 of profit. Magnify that over thousands, you're paying $2.8 million for $100,000 of profit. When the long-term average has been 21 times earnings. So that is where there's an extreme valuation happening. That is where things have gotten really expensive. And that's something to note when you're allocating your portfolios, right? Outside of the TSP, we have the ability to toggle between growth and value. So now we're more on the value side because of the inexpensiveness there. When it comes to the TSP, that's a little bit more difficult. But even looking further, we can also see that there is a relationship between value and growth on interest rate changes, right? So I depicted that era after the recession of '08 when interest rates were at rock bottom lows. Growth performed very well in that low interest rate environment relative to value. In fact, it performed much better, right? In terms of annualized return, if you look at that 0 to 2% range. And in that 2 to 3% range, growth kicked values butt once again. Okay. And this goes back even further than the last slide, which was 1997. This is back to 1979. So in these regimes of low interest rates, growth absolutely hands down takes the cake. And we saw that during that COVID crash as well. They set the interest rates down extremely low. We saw growth take off, right? Now, as you get to a 3 to 4% interest rate, and we are defining interest rates, by the way, as the 10-year treasury, which is very usually going to be close to what the interest rates that the Fed has set up for us. We see 3 to 4%, that advantage starts to really narrow. The advantage between growth to value, you don't see it as much there. There's a slight tilt towards growth. But as we start to get out to the 4 to 5% range, this is where we see value outperform. Okay? And we haven't seen this for a decade, really, right? We haven't seen these interest rates for a decade. We sure as heck haven't seen value outperform for a decade. Growth has been outperforming all the way back to the last major recession, the Great Recession. So we haven't seen the changing of the guard yet, but we now think we're in that range, right? We see risks to growth and we see consistencies in this era that we're in, which is a high interest rate range with value starting to be potentially the better bet. And that is what is depicted on the slide that you're seeing. So as we move out to another bargain, potentially, so we think value is the bargain, not necessarily the growth side of the market, we're seeing another kind of observation, right, in the markets. And this is more on the small caps. So small caps are depicted by your S fund at the TSP, by the way. Large caps are to be depicted by the C fund. And unfortunately, with the C fund, you can't choose whether it's value or growth. It's all combined into one. And we'll be talking about that here in a second as to what our concerns is around the C fund. But when we look at the S fund and we look at other small cap indexes, we're now seeing some of the cheapest valuations relative to large cap, relative to your C fund, that we've really seen here for 20 years. Okay? Does that mean that small caps are foolproof and that they're going to absolutely do well from here on out? Not necessarily, but what it does mean is if we're allocating our portfolios, we need to understand that the S fund compared to the C fund from a valuation standpoint is a lot more attractive. Okay? And that's essentially what this chart is showing you here. The last time we saw small caps this cheap compared to large cap was in 1998, 1999. What was going on there? That was the tech bubble. So all those large growth companies were rallying so hard, but eventually that led to a bust there. And everybody was forgetting about small caps. No one wanted anything to do with small caps. They wanted large tech companies at that point. Sound a little familiar right now? So that's another place where I think, we talk about these recession risks and things like that. But if we just want to stay invested and rebalance our portfolios, these are the areas of the market that we are more comfortable owning right now, right? As opposed to those large tech growth companies that have hefty valuations at this point. Austin, what do you got for us here on the S&P?
Yeah, to elaborate that on that, and we might sound like we're beating a dead horse here. I know we've covered this a couple times, but what I want to show here is the relationship between, we keep talking about these high valuations. Okay, how high are they, relative to where they've been in the past? Well, sure, we're not quite, right now, or as of March 31st, we're here about 21 times earnings on the S&P 500. And so as Neil was saying earlier, price to earnings, this is the price you're paying for every dollar of profit that the company is making. So, yes, we're high compared to average. We're not quite as high as back in the 90s. We got up to a 24 times over here, even just before or just after COVID. We got up a little bit above where we are right now. But in terms of averages, anytime it kind of crosses this 20 times line, historically, we don't last there for a very long time. And specifically, when you look back through history, and this is really interesting to me, when you look back through history and you look at the relationship between where that PE multiplier is, so that that's coming along the bottom here. The further off we are to the right, the higher the PE ratio. And then we look at the returns over the next year, and then the next 5 years, along the vertical axis here, we can see that there's the further out you get to the right, meaning the more expensive things are, the worse they typically do over the next year. And over a year, you can see there's quite a bit of variability here. So this is about where we are right now, about 21 times. And there have been times in history where, hey, 1 year later, we're at 40% from there, right? There have been times where we're down 20%, but the average is maybe up a couple percent, or the mean. Now, when you go out to 5-year annualized returns, and this really gives us a better picture of what does the future look like after price to earnings get to this level, you can see there's a much more consolidated average around this line. There's much less variability when you go out 5 years, and there's a pretty small grouping here about where we are right now, somewhere between 0 and 8 to 9% a year is what we're looking at. 8% maybe being the high end of that, -1 being the lowest. The 5-year annualized returns, a couple percent a year from where we are right now going forward. And at these lower valuations, you can see you can expect quite a bit higher. Neil, do you have something to chime in with there?
I said, yikes.
Yeah. And this is just reaffirming the point that, some of the changes that we've been making in our portfolio lately, some of the things Neil was saying, where we are liking value, we're liking the smaller side of the market, things that have a lower PE, lower price to earnings, that we think have better potential over the next 5 years. Are they going to miss out on some of this AI boom? Maybe. But are we okay with giving up, some of this return in the next year if it saves us over the next 5 years, because we don't know exactly when that timing will be? Absolutely. So these are the things we're looking at that are guiding our decisions in the way we structure the portfolio.
Yeah. So this kind of comes back to, I think, some of the things that we've discussed before. And, this is a depiction essentially of your C fund at TSP for folks that are tuning in with their federal TSP still allocating those. It's very important for you to kind of see what your S&P 500 typical C fund is invested in, and why we've talked about some of the concerns there. So if we look at the far right chart, right, and we look at the weight of the top 10 stocks in the S&P 500 right now, they are weighted at 33.5% of that fund, the C fund, right? Which means 1/3 of your fund is in 10 stocks right now. Okay. From a diversification standpoint, that is the most skewed that we've ever seen the S&P 500, the C fund, in history, right? And that is a concern, because if that leadership gets taken out, there's disappointments to earnings of the top 10 companies. There is a lot of weighting in those 10 stocks right now to the C fund, okay? And that would really be brutal to the to the valuation of the fund if those 10 stocks trip up. The other thing I'll point you to is the bottom right chart. So the bottom right chart shows the earnings contribution to the top 10 stocks over the last 12 months. And notice that that's only 25.5%. So we're seeing a weighting of 33.5, but we're only seeing an earnings contribution of 25.5. And that might not seem like a big deal to you, but that's an 8% delta. That means that we're valuing and pricing these stocks to be a third of the index. But really, from an earnings contribution standpoint, they only make up a quarter of the earnings of the index. So again, that brings us to an overvaluation standpoint, which is why kind of on that left side, you can see those PE ratios of those top 10 stocks are 28 times versus the remaining stocks in there are 18 times. Okay. And from historical average standpoints, we're overvalued. We're overvalued on those top 10 stocks. Typically, they carry a 20 handle, and now they're at 28. And that's bringing the larger S&P 500 up to 21 times earnings versus 16.5. That is why this is happening. It's really on those top 10 stocks. And we can continue kind of beating this up. And we can make the argument that those top 10 stocks just could continue on forever doing this. But that's usually unlikely, right? We've seen this before in the 1990s where we've seen these top 10 stocks go up to huge valuations only to disappoint later because they were set for essentially perfection, price to perfection. And if we go to the next slide, we'll actually see how this leadership changed. So what this slide actually depicts is market cap versus equal weight performance of the S&P 500. So market cap, guys, is when we are looking at your C fund. 33% of the C fund is in 10 companies. That is market cap. So we're basing that on the valuation that the market is set for these companies. That is the allocation of the C fund. That is market cap. Okay? Versus equal weighting all 500 companies as an equal weight to the 500 that go in the index. So taking out that huge 1/3 being in the 10 companies and setting that as an equal weight is what you're seeing in gray. So you'll notice there's been times where market cap outperformed equal weight, but you will also notice that equal weight, setting all 500 companies equally, not having this huge allocation towards the top 10, has actually over time, going back to the 1990, been a better strategy. The diversification has been better. There's been more outperforming periods, 53% versus 47. There has been more in terms of value return, risk-adjusted return, right? In terms of valuation, you had 17 versus 21. And what you also notice is when the changing of the guard happened. So I'm going to single out 1991. Notice the very far left of this chart, market cap was outperforming, right? You see green. But in 1991, what happened? There was a recession. So a recession sucked out all of the excess value that was happening on the market, and a new leadership change, the equal weighting. That means all of the other 490 companies, for the most part, outperformed those top 10 companies at that point. And that happened for a good 5-year period. Then market cap led the charge again up until the late 1990s, What happened there? Brutal earnings recession, essentially on the market leadership, the tech companies. You saw a major surge from equal weight at that point. That leadership of equal weight lasted for a decade afterwards. So we saw almost a decade of market cap outperforming, but then we saw a decade of equal weight outperforming, which essentially is the more diversified choice of the S&P. You saw that happening up until call it 2006, 2007. Then market cap began to creep up to be the top performer, only for a short period of time, and you saw another brutal recession wipe out all of that outperformance on the market cap. We started a new regime again of equal weight that went on. Huge surge there to equal weight. Essentially, what that's telling you is the market was unbalanced and that market cap was too expensive and that the rest of the market was cheap, and you saw a shift. That essentially plays out, bounces back and forth in 11, 14, 17. Then you see the resurgence of market cap again, followed by the COVID crash, and then you saw the equal weight essentially take it from there. Now, what do we have happening again? We see a major outperformance by market cap happening as of right now, with P ratio surging. However, if we look at history, we can kind of see a common denominator here. And the common denominator is market cap can continue leading the way here. We're not calling for a crash. We don't know when that will happen. But we do believe that turnover, that changing the guard will happen when we get economic weakness. That is what we can't call right now, right? It's too early to call for a recession. We are in an inverted yield curve, which has been a recession indicator almost 100% of the time. We are in the conference board indicators all pointing towards a lowering economy. But none of that has actually happened yet, right? But we believe that when that does come to fruition, and that could still be another 12 months, that could be 18 months, there will be a leadership change, right? And that is why we were slowly over the last, say we call it 9 months, we've been shifting over to the equal weight in our portfolios. We've been shifting more over to value. And yes, there's been more juice out of market cap coming, and we're okay with leaving some of those returns on the table if that's where the leadership's coming. It's just simply becoming more of a riskier proposition to just own the S&P 500 flat out as it is as a market cap index, which is your C fund, than it is to bring that into equal weight and diversify that more, in our opinion. Austin,
Yep.
Anything to chime in on that?
No, I think you tied that up nicely, and I'll put a bow on it here, and we can wrap up and get to questions. So we include this at the end of each of our webinars here, but it's just always so important. So tips for investing in this environment. What we've been saying throughout this whole year is maintain a balance between growth and value. When the market's going up, everyone feels brilliant, right? You want to be in growth. You want to be chasing returns. If you're not, you feel like you've got the fear of missing out. You're leaving money on the table. But when we look back at that and you can see, hey, having a balance over time really pays off. So we want to maintain a balance between growth and value. We want to be mindful of the concentration risk. If we're in the C fund, if we're in the S&P 500, understand that you're not really evenly spread between 500 companies. You got a third of that in the top 10, right? Like what we said before. So if you have the ability, taking a more equal weight approach, diversifying into value, into small cap, mid cap markets makes a lot of sense. And also, we didn't really focus on this in the portfolio or in this webinar as much, but don't be afraid right now to use some bonds in the portfolio. You know, using some F fund and the TSP, things like that, can be a good diversifier, and those should really benefit from at some point when rates do start coming down. Bonds will benefit from that. So just things to remember for any time when you're investing in the markets, right? We can't let our emotions drive our decisions. Like I said, it's so easy to feel smart, to be excited about things, and love the market when it's going up, and then feel stupid and taken advantage of, and want to take everything out when the market's going down, and you just can't uh, think that way in the markets, and that's what we try to help our clients with, especially. Understand your risk tolerance. Uh, don't chase return if you're not going to have the stomach to watch it go the other direction. Be diversified, stay invested. These are the things that we're coaching people through all the time.
Yeah, this is exactly what these 101s are made for. So if there's anyone listening in would like to address some of these issues in their own thrift savings plan, go over their allocations, or talk about any of the other issues that come up on financial checkups, feel free to take part in one of our financial checkups. They are complimentary. That can be done by going to our website or scanning in the QR code that's over there on the right. That'll take you right to a registration page where you can discuss one of the many topics on this list, including the TSP. Lastly, I will say, if this is your first time joining in and you have tuned in, but you haven't actually subscribed to our YouTube channel, we would love for you to join our YouTube family, where we will be posting not only videos that are market commentary related, but I got a great video coming up next week, which will be on estate planning, but specifically on taxation, on what your heirs get, and how you can maneuver some tax techniques to make that less impactful to them from a tax perspective. And we're not talking about estate taxes. So I'm talking about capital gains taxes and income taxes that heirs face on inheriting your stuff. So that is what the video is about. It's a 10-minute video. It's coming next week. So if you subscribe to the channel, you'll get that notification that that video will be uploaded. And then additionally, what also helps our algorithms is for you to like the video. Like the video, and that also gets that out to all the other federal employees that might be wanting to see something like this. So that is just helpful for us in general. If you will do that, we'd be highly appreciated. Other than that, we are done for today. Thank you so much for tuning in. I do not see any questions in the chat bar. I'm almost starting to wonder if it's not working. But that is currently what is going on. Austin,
Yep.
you see any chat?
I don't.
Question?
So yeah, like I said, if you have questions, one, sign up for this questionnaire. That's a one-on-one call with one of us or one of our other financial advisors or coaches, and or shoot us an email. That works as well. But we'd love to talk more. Sorry, we've had issues with the chat, but we'll just wrap this one up. And yeah, thanks everyone for attending, and we'll catch you next month or catch you with other videos on our channel.
Awesome.